Most people invest in companies they see every day, their local banks, tech firms, or grocery chains. But here's the truth, the world is much bigger than your home market. Globe showing Europe, Africa, and by ignoring global investing, you might be leaving huge opportunities on the table. So, should you buy stocks outside your country? Let's dive deep and find out. First, let's talk about why many investors stick to their home country. It feels safe and familiar. You know the brands, you understand the economy, and you see these companies around you. This is called home bias, and it's completely natural. But here's the downside: if your entire portfolio is tied to your country, your financial future depends on just one economy. And economies can rise and fall. Now, what happens when you look beyond your borders? Diversification: if your country faces a recession, other regions may still grow. Access to global growth: some of the fastest growing companies aren't in the US, Europe, or wherever you live, they might be in Asia, Africa, or Latin America. Currency advantage: if your local currency weakens, global investments can protect your wealth. Think about it, by investing globally, you're not just betting on one horse. You're spreading your chances across the entire race. Let's look at some real examples. In the 1980s, Japan's stock market was booming. Investors who went global and bought Japanese equities made massive gains. In the 2000s, emerging markets like China, India, and Brazil outperformed many developed economies. Even today, sectors like clean energy, e-commerce, and fintech are exploding in countries outside the US. If you had only invested locally, you would have missed these waves. Okay, so how do you actually invest in global stocks without becoming an international expert? There are 3 simple ways. International ETFs and mutual funds: these are funds that bundle stocks from different countries. For example, an emerging markets ETF could give you exposure to companies in India, Brazil, or South Africa. Buying foreign stocks directly: some brokers let you buy shares of global giants like Toyota, Samsung, or Alibaba. ADR stocks, American Depository Receipts: if you're in the US, ADRs are a way to buy foreign stocks that are listed on US exchanges, making it super easy. These tools make global investing as simple as buying your favorite local stock. Of course, global investing isn't risk-free. Let's be real. Currency fluctuations: if the dollar or your local currency strengthens, foreign investments might lose value when converted back. Political risk: some countries may have unstable governments or unpredictable policies. Lack of transparency: not every country has the same accounting standards, which can make analyzing companies harder. But remember, every investment has risks. The key is balancing them with the potential rewards. So, should you move all your money abroad? Not at all. A smart strategy is to blend both. Keep your core investments in your home market, but allocate a portion, maybe 15 to 30%, to global markets. This way, you enjoy the stability of what you know, and the growth of what you don't. In today's world, money moves faster than ever, and opportunities are truly global. By limiting yourself to just your country, you're putting blinders on your financial future. So ask yourself, do you want to rely on just one economy, or do you want to ride the growth of the entire world? Globe showing Europe, Africa. Start small, explore global ETFs, research new markets, and let your portfolio benefit from the power of international growth. Because in investing, borders may exist on maps, but not in opportunities.